When I think about the trajectory of inflation, I think that we've made a really good progress on it. If you think about where the economy was and where inflation was last summer compared to where it is today, we've seen really positive things happen. We're not at the 9 and 10% levels. We're in 4.5 to 5 range. Now, look, that's still two times what our target is. So there's still a ways to go. But I do think that we've seen a lot of some of the froth really come out of the inflation measure. One of the things I look at, one of the measures I try to keep track of is the number of goods in the basket of this that's used to calculate the CPI that are showing inflation above 5%. Right now, in the latest report, that came under 50%. Less than half now are in that range, or at one point it was 70 or 80%. So I think we're seeing that breadth narrow, and that's a really positive sign. So I think we are starting to see our policies really work. Look, in today's environment where there's so much uncertainty in the economy, I don't think we can really rule out anything. Look, I think we are in a place now where we've been in restrictive territory for something like 6 to 8 months. That's about the time you'd expect to see our policies start to bind on the economy. And when I talk to businesses, they tell me they're starting to feel that bind, and that's a really positive thing. But as you know, we've had surprise after surprise after surprise over the last few years, and most of them have been to the negative when it comes to getting closer to our inflation target. So I've got to keep that on the table for sure. But right now, I'm feeling like let's see how our restrictive policy is working, and that'll give me a sense of what our next move needs to be. So, it's really interesting. Through most of the pandemic, our business contacts have said, if we needed to raise prices because our costs for input were going up, they could just pass that through, and the consumers were accepting that. I'm hearing much, much less of that now, and many of the businesses and the people in the marketplace are telling me they're pretty much at the limit, and their ability to continue to raise prices and pass through those higher costs is far degraded, in part because consumers have become a lot more price sensitive, which again I think these are the things that we'd want to see if we were getting to a place where the economy was moving back to balance, which then would get us to that 2% target. So pricing power is not nearly as clear and as ruthless as it has been. I think that's really positive development. Everyone is telling me that their labor market experiences, their ability to hire, and their turnover internal to their businesses is far better than it was last summer. Now, it's still elevated and tougher than it was before, but there has been progress made. The second piece to this, though, is that we just came through a pandemic where many families are thinking about how they're going to work. Many employees are thinking, what is my connection to the labor market? We had all these retirements. So there's a lot of churn that's happening. I think that's contributed to some of the historically low unemployment numbers that we've seen. I am hearing that businesses are saying, we don't want to let some of our best people go because it may be very difficult to get them back. I am definitely hearing that, but I'm mindful for how you started this. Every time there's a declaration that this time is totally different, it winds up not being totally different. So we're going to just keep our eyes open, my eyes open and our team. We're going to be out there really trying to understand where things stand. I do think that the pandemic is triggering some real structural changes that it's going to take a while for us to understand those things. But we're going to have to understand those before I'll be willing to make any declaration that the old laws of labor markets don't apply. That's a good question. So, look, as you noted, when we raise interest rates at the Federal Reserve, we expect loan conditions and lending conditions to tighten. That has happened. That I usually don't want it to happen in such as volatile a way as it has with the Silicon Valley Bank challenge and other things. But a lot of this is going as expected, as I expected it would. Now the question is it going to accelerate? Is it going to stay where it is, or is it going to slow down? The bankers that I talk to tell me that the rise of liquidity risk as something that's really on their radar screen has caused them to want to be more conservative in terms of their willingness and desire to lend. But I'm not hearing right now that they've gone into hyper mode where we really have something that I would characterize as a credit crunch. We're not there today, and I'll be monitoring to see if we get closer to something like that. We definitely want to see what the official numbers are saying, but through our regional economic information network, we are talking to businesses all the time. Through our surveys, we have a pretty robust survey shop, and we're talking to businesses, and we get feedback from businesses in those cases. And some of the questions we ask are, as you're setting wages moving forward, are you doing that as a catch-up because your workers feel like they're falling behind, or are you doing that because you think that pricing is going to be where you need to do that? Today, what businesses are telling us is that they're in catch-up mode. Their employees know that their wages have fallen behind inflation, and to keep them, they feel like they've got to allow that catch-up to happen. But we are also, and that to me, that's a very positive thing, because it says it's reactive and not proactive. And as long as we stay in that environment, I think the probability that we get inflation to continue to recede is very positive. I would be more inclined to change if inflation came down quickly. Look, inflation is high, it's too high. We've got to get this back to our 2% target. If we do not do that, inflation expectations change, and you might get into this cycle where it becomes very, very difficult to get back down to a reasonable level. And that has all kinds of bad implications for families, for investment, for businesses, and for the country. So we've got to get that under control. The scenario for me of a rate cut, which I don't think is what's going to happen, is that inflation really starts to come down robustly through the course of this year. My models and my team and my outlook really tell me that I'm expecting to be in the mid to high threes by the end of this year, and that's still quite a ways from 2%. If I was wrong and inflation was much lower than that, then there would be a conversation on it. But I think right now, if you had to tip the scales, the next move is going to be an increase or a cut. It's pretty heavily weighted to the increase for me at the current moment.
Bostic acknowledges that while headline CPI and core CPI have come down from their peaks, other measures of inflation in the Atlanta Fed's underlying inflation dashboard have worsened compared to a year ago. He believes that progress has been made in reducing inflation, but acknowledges there are still a long way to go to reach the Fed's target. He states that in current uncertain economic environment, the Fed cannot rule out any other further rate increases. While businesses are starting to feel the effects of restrictive policies, Bostic remains cautious due to past surprises and the need to closely monitor the impact of our current policies. He indicates that if he had to vote right now on the June meeting, he would probably vote to hold rates, but there are still 2 more inflation readings and a jobs report to consider. He notes that businesses in the 6th District and survey responses suggest a forthcoming slowdown, and he wants to see how that plays out before deciding on the next move. Businesses are experiencing reduced pricing power, and their ability to raise prices and pass on higher costs to consumers has diminished. Consumers have become more price sensitive, which Bostic sees as a positive development for the economy. He mentions that labor market conditions have improved compared to last summer, but remain elevated and challenging. The pandemic has triggered significant changes in labor market dynamics, with many employees reassessing their connection to the labor market. While businesses are reluctant to let go of their best workers, Bostic is cautious about declaring that this time is entirely different and will closely monitor developments. Finally, he notes that as the Fed raises interest rates, low conditions and lending standards tighten, he acknowledges that liquidity risk is a concern for banks, but currently there is no credit crunch. He will monitor the situation to see if credit conditions worsen.